Hi, this is Randy Finney with the Right Side of the Chart, and today is Friday, January 17th, 2020. And this video is part 2 of 2 on general stock market analysis, focused primarily on QQQ. Although we're going to look at some other things on here, and what I'll do in this video is cover some market breadth indicators and sentiment indicators. So we're going to start out here with some of my sentiment indicators, and this one pretty popular indicator. It's the AAII, that's the American Association of Individual Investors, if I'm not mistaken, bulls versus bear spread. So what you have here is they take a survey every week, and people, that are, members will share whether they're bullish or bearish on the market for, in the near term. And obviously the higher spread, this red zone I have marked here, shows where pretty much, again, it's what I call the red zone. When the readings get that high, these gray bars right here, you hit that extreme reading of extreme bullish sentiment. Now I want to note, and I'm trying to do this, as I always try to do my analysis as unbiased as possible. This one's not flashing any like red red warning signs yet, or at least not in the red zone. It is elevated, and it's certainly high. In fact, it's as high as it's been since the beginning of 2018, but you can see we haven't hit the extreme that it did back in late 2017, early 2018. If you recall, we had just a tremendous, very similar but even more powerful, slow and steady grind. Here, let me pull a chart and I'll show you that. Let's look at QQQ. Let's turn off all our annotations. These are the things from the other video. Here, we'll get rid of these for now. Park this over there, park that over on the side, and just show you back then this is what I'm talking about. Okay, so this was a slow and steady, unprecedented low period, a period of low volatility, never before seen in history had the VIX gotten so low and stayed there for so long. And then abruptly it ended with a bang. We had actually a blow off top, sort of a mini blow off top. You can see right there, near parabolic advance, where instead of just kind of grinding higher like it was, steady grind, we just had almost a persistent rise right there, followed by an even sharper drop. We kicked it back up again, sold it again, and then volatility, of course, expanded from there. And we once again started returning back to low volatility this year, and we've been in that kind of similar low volatility grind right now. And so again, like I like to say, the takeaway is that these things, I'm not going to say can end out of nowhere. This one was identified. The day we broke down, it was identified, and I posted on the 60-minute chart. We were tracking a bearish rising wedge, an uptrend line, divergences, everything similar to now, and it broke. So what didn't come out of the blue, just as this big drop here too. But posted back at the time. Major sell signal on the U.S. stock market when we had a primary trend line, even on the daily chart. I was watching on both QQQ and XLK, so that one didn't come as a surprise either. Nor will the next one once we finally break, especially the daily trend lines that I covered in the last video. So again, I'm not going to go over price. I just wanted to show you, going back to this other chart here, that grind leading up to there. So where was it? Right here. There we go. So that's it. We're not as extreme as we had been at some other points in the bull market here. And remember, those, you can see those extremes were followed by big corrections each and every time. I'll let you stop. I'll try to include a copy of this chart below for you. And there's your buy zone. I have a green zone. When you get to that zone, that's where you want to step in and buy. That's because everybody's bearish. So that's that whole contrarian thing in trading. And even Warren Buffett said it. You want to buy when there's blood in the streets, and that's usually when the best buying opportunities are. But not always. Sometimes, especially during a bear market, and this is what we need to be cognizant of, is that sentiment will start to become increasingly bearish. Oversold will become more oversold. That's when you're in a bear market. I talked about it recently in gold. For example, when you look at gold, I'll go to a weekly chart, and here we go. And a signature of a bull market is overbought readings. And of course, we're using gold, but same thing in the stock market. Gold just shows it a little more extreme. The signature of a bull market is persistent oversold readings, overbought, I'm sorry, and when you become overbought, that's above that 70 level, the red line there, you tend to stay overbought for an extended period of time. So if you try shorting overbought in a bull market, meaning a tag of the 70 level on the RSI, it's not a very good profitable strategy. And you can see during that bull market in gold, that last bull run, we'd never even hit oversold. We didn't hit oversold until the bear market started. So once again, a signature of a bear market is oversold tends to stay oversold for an extended period of time or become more oversold once you cross that, hit that 30 level. And it's more common, you can see it here, to see oversold readings in a bear market. Now, this is where the bear market ended in gold. It started here at the top, and the last bull ended there, and you can see, boom, bull market action. More bull market action, extreme overbought reading. In fact, the only oversold reading we've had just these two right here and here, and they were fleeting. And we've had a lot more overbought readings since then. So the same thing kind of works with the stock market and again, some of these different indicators when you look at these extremes. So I wanted to point that out, is that, you know, this red zone may change. Yeah, sorry, that pop-up was the video. I just finished the previous one popping up. YouTube just finished uploading there. All right, so we'll watch that. And again, like I said, sentiment is high. It's excessively bullish now, but it's not at the red zone, not at, again, at the extreme level now. So there is room to go in this rally as far as this one indicator, but nor does that mean that we can't stop, because again, you can go back in time and you can see there have been periods of other corrections after, you know, the levels that we hit, just, you know, such as this one right here. You came about to where we are right now, and there was a pretty decent correction from there. Okay, and what I like to say about the sentiment surveys is that it's a whole different thing speaking the bearish or bullish speak, or actually being long or short. There's a big difference. I may say that I'm bullish on the market, or I may say, as I have, that I'm bearish on the market, but yet, you know, 90+% of my trades in recent months have been long side trades. So I'm looking at the market, I'm looking at these developments. So point being is, you know, someone might say they're bullish or bearish, but they aren't necessarily long or short. I'm sure a lot of those people are, but not all of them. And so I like to use these other indicators because this is, you know, they're putting their money where their mouth is. They put to call ratios. This one is the CBOE total put to call ratio, and you can see here I have up above, let me change, well, I can use this. I have a green line right there about between the 150 and 155 level, and it's green because that's where you want to step in and buy. That's when the put call ratio gets very high, means a lot of people are buying puts because they're bearish and they're scared, and that's when you step in. Now in a bear market that doesn't always work, but once you got in a bull market, you can see it there and there. The lows usually come around those high marks right there, major bottoms right there. Let's see, that one was nope. Sorry, that one was a failure. Like I like to say, there's not any one indicator that's 100% effective. That one nailed the bottom after the 10% drop. This one pretty much nailed the bottom there. This extreme came maybe a little early right there. No, there's a line. If I can grab it, I should have put a vertical line somewhere. Yeah, actually it's right about there. Here, let's put a crosshair here. There we go. So if I put the crosshair on that extreme line, look down, boom, nailed the low. So the green line is excessive fear or excessive put buying, and the red line down below, that's your buy point. Let me turn off that crosshair line. All right, so I just want to point out, as far as this one goes, we're not flashing anything, but you can see all along here, these boxes are what I call clusters. Sometimes you hit these extremes and then you hit them again, just like overbought readings or oversold. You can hit these clusters. So you had 3 different tags there, and then boom, 16% drop. You had a cluster readings here, boom. No, it never panned out. I highlighted that one back there, but it didn't pan out. I haven't updated this chart in a while, but I wanted to cover it now because look, we just hit that level there, and so it's a good good point like I made over here. Not all of these readings always pan out, but you can see with very few exceptions, you get the cluster 18% drop. There was another extreme reading followed by a 21% drop. There was one right at the end of the last bull market followed by the 56% or 55% drop there. And there we are again. So I wanted to point that out, that we're pretty much just recently hit that level. Maybe we get a cluster. Market maybe rallies, or maybe it's a one and done like back here when we had a 21% drop. Okay, so the CPC was the total put to call ratio. Now here's a different one. This is the CPCI, which is only the index put to call ratio. So people buying puts or calls on the S&P 500, for example, and you can see that it's done a pretty good job. And again, I like to use these all sentiment surveys, by the way, whether it's the AII. I only pay attention to them or put much of a weighting when they're at extremes. Anywhere in the middle is just noise. Over the years, I've analyzed them left, right, up, and down. I find no predictive value or very little. Sometimes you can sniff out divergences, but you want to keep it simple and not try to extract too much from these, your indicator buy and sell signals. If you filter out and just use the extremes, it's going to minimize your whipsaw signals. So there it was. There was an extreme right there. 55% plunge in the S&P 500. The next time we hit it was right there. You can see these little dashed lines down below. Sometimes we got corrections, sometimes we didn't. Here was a cluster, 1, 2, 3. See, these were persistent. 4 in close proximity, cluster that pretty much stalled out when we got those 4, and then followed by a 15.3% drop in the S&P 500. There was another couple that didn't pan out, but then boom, we hit it there, 11.3% drop. But we had just a marginal new high followed by a 20% drop. So you could say, this was probably box set in as a range, a period of persistent low put to call or a low put to call ratio on the index options. I just want to say right now we don't have that. So it is missing, and take it for what it's worth. We're well up in the middle of the range, so I probably spent more time on that than I should have. But again, I don't want to just pick the charts that are making the bearish case here. Show you that some of these are flashing warning signs and others aren't. And here's one. Oops, I gotta center that for you. Here's one that is almost certainly flashing a warning sign right now. This is the CPCE. So now you're looking at the equity put to call ratio, meaning individual stocks, puts on Apple or Intel or calls on Apple and Intel. So it's a ratio of puts to calls. And same story here. When you hit these extremes, I set these lines at levels that in the past, green is buy. So you have a green line there, about 78 or so. When you get to that point, you can see the green arrows. You can stop this video, see the arrows on the chart. They do a good job of saying, okay, that's when you want to be buying, because everybody is fearful. People are buying puts, more puts than calls. And then the inverse holds true. This is complacency. These are people buying more calls than puts, and you can see the returns down here. If you can't, I'll read it out. That's about a 19% drop, 22% drop, 7% drop right here, 7.5%, 10% there. That drop off the red arrow. You can see where we cross the line. This one here, we had an initial drop of about 12% there, followed by a marginal new high, and then a 20% drop right there. And now here we are. This is the deepest reading that we had, the lowest reading on the CPCE since going back all the way to, was that 2011, almost 2010. So been quite a while. That's something worth noting. Okay, now we're going to move on to a few breadth indicators. Market breadth is kind of, taking a look under the hood. If you see a rally in the market, what you want to see is the majority of stocks participating. What's not healthy is when just a handful of stocks are doing most of the heavy lifting. So what we're looking at here on this first chart is it's the Nasdaq Composite up top. No, I'm sorry, the Nasdaq Composite's on the bottom down here. And this is the NAAD. That's what the symbol they use on stock charts, which is the Nasdaq Advanced Decline line. And it shows the numbers of stocks advancing minus the falling stocks. And so what you want to see is in a healthy market, see these green lines here? I made them blue, of course, here. This is a healthy rally. For example, when the bull market started, after the bear market was over back here in '09, you can see that the market was rising along with the NAAD. So you had more stocks advancing than you had falling, and that is a signature of a healthy rally. You saw it here, you saw it here, you saw it throughout that's that Trump pump right there, where we had that unprecedented period of low volatility but steady gains in the market. And then what you don't want to see, or what's usually not a good sign for the market, is divergence. So back here you had leading into the market top in 2007, you had the market going up down here. Remember, again, Nasdaq Composite on the bottom, and you had the NAD steadily falling. So it was showing you that fewer and fewer stocks were advancing, yet the market continued to rise. And so another way to look at that, it was just what we're seeing now. Most of these top heavy FANG stocks, the market leading stocks doing most of the heavy lifting, where under the hood you had started to have more stocks dropping, yet the market was still going up. And then that was, of course, followed by a 56% or so correction. And then you can see divergences along the way. These red boxes are the corrections that came after those divergences, and you can see right here. Here's the advance right here, the divergence line. You have the Nasdaq Composite rising since about actually since the peak before right there. What is that, about mid 2018? And yet so far we're still below that peak right here. So that is divergence. That's negative divergence. A healthy rally would have the NAAD going up as well. So there's something to note. Okay, here's another one. This is the NAAD daily. You can see the same thing here. We're going back to 2001 here, and you can see the divergences that have been formed before. I should make clear: Nasdaq Composite up top, the NAAD down below. Number of stocks, advanced decline line. And so you see the composite rising into the highs of 2007, while the number of stocks advancing versus declining were falling. Then that's, again, doesn't look like much, 55% drop. Everything was good for a while, but you had divergence, correction, you had divergence, correction, you had divergence, correction, and we continued to diverge right there. Let's look at another couple and we'll wrap this up. And I can go on and on. There's a lot of these similar indicators. This one's the Nasdaq Mcclellan Summation Index, and you can see the Nasdaq below. I don't have the correction line. These are divergence lines. Again, if you see a blue line going down, it means prices were going up at the time. And then you can see that was, again, doesn't look like a lot there. That's a bear market 55% drop. Leading to that one, we had divergence there. We had a big drop, correction there. It's the scaling, because I can't set this to log scaling, that it doesn't look like much. But again, big divergence heading into that 2015 correction / bear market in a lot of sectors and indexes. The S&P 500 and Nasdaq just barely missed the 20% drop designation for a bear market back then. Remember the big drop last in 2018, the last quarter 2018. That was it, preceded by divergence, and there it is, significant negative divergence as we head up now on this rally. All right, towards the beginning of this video, I covered the NAAD, but on the daily chart, along with the Nasdaq Composite. This is the NAADW, which is the weekly. It's showing just some weekly, even though it's a line chart, on weekly readings. And this goes back to actually leading up to the dot-com pop. Right here was the dot-com bubble, which burst in March of 2000, followed by one of the worst bear markets in history right there. And we were diverging. I can't go back here to the left of the chart. Those lines would continue. The divergence lines were building up to that point. Significant divergence. This was, and a weekly chart, it's just fewer lines. That other daily chart I showed you had a lot of lines, had all the smaller corrections within. But again, this is the big picture, and this stuff is just, it's very clear to me. You have these, heading into the peak. Again, the market's down here, the Nasdaq Composite. Market's rising. The number of stocks advancing versus declining is falling. And then look, there was a noticeable drop off right before the top. You had divergence up to this point, and then all of a sudden the NAAD line, the NAAD line had a sharp drop off while prices continued up. Now we don't have that right now. We do most certainly have the divergence, been building for a while, but what we have instead is a very sharp move in price. And you could almost equate that, if you will, to the sharp drop off. So in other words, with this thrust up in price, you should see, if it was a healthy rally, a comparable thrust up in the NADW. You don't. Why don't you? Because Apple, Amazon, Facebook, Microsoft, they are accounting for the bulk of the returns, not the other, well, in the Nasdaq Composite, you have a lot more than 100 stocks, but the Nasdaq 100 is just, the top 100 largest there. And so that's what, if I put the NDX, it would almost mirror the comp. It's the same, pretty much the same thing. It's, even though it's more stocks in the Nasdaq Composite, the charts are going to be very similar. Okay, and here's another one that might help to confirm the next sell signal or trend change. A lot of these I'm showing you divergences. And again, you need to couple that with the first video, which are price support levels, trend lines, things like that, trend indicators. We look for sell signals there, and then the divergences that I'm covering mostly in this video kind of paint the bigger picture as, okay, how big the next move might be based on the scope of the divergences and things like that. All right, so now this one, although we're using a breadth indicator, there's some sell signals within here. This is the NAHL, which is the new high Nasdaq new highs to new lows index. And so what I've done is I've added a 20-period EMA to the line. So the line is here. Hard for you to make out, but what I've done here, see these red and green lines? That's when you get bearish and bullish crossovers. In fact, I added a customized histogram here to show you when those lines cross. In other words, when the NAHL crosses above or below the 20-period EMA. And so red is a sell signal when the lines cross down. And if you go down closely, and again, unfortunately, like the stock charts, you can't put log scaling down here, but these are significant corrections, and it shows you that those crossovers gave you some pretty good sell signals on the market. Now, we don't have that in play right now, and as I've said in another video, there are 0 sell signals at this point in time in the market. But we'll watch that. You can replicate this chart and look for a crossover. If you do the histogram, just put up a MACD and then change the settings as I did here to 120.0, and that will show you when the line crosses. The other takeaway is there's also trend lines under that as well, and you can see they've done a pretty good job of triggering. Right there, you had an uptrend. It broke right here. That was the top right there. There's the top in 2007, the end of the last bull market and the beginning of a 55% bear market. So this is our big secular bull market uptrend line right now. So there's your first sell signal would come when the lines cross over, because they're going to have to cross over to turn back down. And then your next and even more powerful sell signal would come on a solid breakdown below that uptrend line there. And again, that's the NAHL. And if I don't do so, if you're a subscriber, just post in the comment section below. If you'd like, I can give you a link to this chart, and then every time you open that, it should refresh and update the chart. Okay, and if you're a glutton for punishment and you're still here with me this far into this one, and especially if you watched the first video that I did earlier today, if you recall in that one, I put up a custom indicator that I had and showed you the percentage, or the distance, the percentage above the 200-day. Now that's similar but not the same. So again, in that chart, I had some lines for the 50, the 200-day daily moving exponential moving average, the 40-week moving average, and the 20-month moving average. And those lines showed me the value on that showed the percent trading, that the index was trading above those moving averages. And then I put a horizontal line to show you that we were at or very near extremes in the past, in recent years, that were all followed by some significant corrections. Okay, so this is similar, but what this is showing you is the total percent of stocks in the Nasdaq that are trading above their 200-day moving average. So top you have the Nasdaq Composite Index right here. This is the Nasdaq Composite, that brown line. And down below you have the NAA 200R, which once again is in percentage terms. So you're never going to have 100. You're not going to have every single stock, especially in the Nasdaq Composite, trading above their 200-day. Nor you're going to have rarely or theoretically it's possible, but you're probably not going to see all of them trading down. But those would be the bounds, 100 and 0. And again, an extreme is when you get up here, as you can see, about 80. So you can see over time, what's happened is during the last bear market, shortly before it was over, you had back in October, that's where this bottomed. And then you started going up. So there's a takeaway too. You had divergence. That's positive divergence. So you had fewer stocks trading below their 200-day, or I should say more trading above their 200, same thing, as the market continued to go in and bottom into the lows. And so what I look for here is divergence, because again, in a rally, like you had a rally here, right? You had a rally, of course, leading up to the last bull market top right there. And what you want to look for is, in a healthy rally, you should see more and more stocks trading above their 200-day. But when you start to see that dropping off, fewer stocks trading above their 200-day, but yet the market's rising, again, it's showing you the same thing. Fewer stocks are doing the heavy lifting, and that is not a good sign. So this, again, these are market internals we're studying now. That's a subsector of technical analysis, market internals, and these are, what we call breadth indicators. And there it is. So you can see each line. There's no reason for me to spend 5 minutes on this. You can stop the video, replicate it. You can see these divergences, and then you can see, as I measured out, the corrections that resulted in these divergences. And sometimes you get a series of divergences, and little divergences, smaller correction. And you had about a 22% drop right there. And that divergence that started back here on this run is still very much intact. You can see the market ripping on to new highs, yet this line continues to diverge or not keep up. And again, this is not a sell signal, because it wasn't a sell signal here, it wasn't here, it wasn't here, and it may not be here, or it could be. So we couple this with everything else I covered in that first video to look for those sell signals. And what this tells me, and the whole reason for me to spend all this time on this, it paints the bigger picture. Typically the bigger divergences, the bigger the correction. You can see since the bull market started, you can see these were relatively small divergences, right? Followed by relatively, not tiny, but relatively minor corrections. We had a big drop there. That says 18%, but remember, we also traded sideways. These were quick one and dones. This was a 2-year sideways grind. The market peaked and didn't take out those highs till almost 2 years later. And that was so you can call this a deer market when you trade sideways. It was almost a bear market as well, and almost hit that designation there. And that's where we're at now. And then finally, you can do the same thing with the percent of stocks above their 50-day. It's a little it's a faster moving average, but it's telling you the same story. And you can see, again, going back here to, looks like 2005, you can see the divergences and how they played out in the past. 55% correction, little divergences, smaller corrections along the way. And right now, it's pretty pronounced. You can see this is the Nasdaq 100, or NDX. I use the Nasdaq 100 here, not the Nasdaq Composite. Ripping on to new highs, yet that's not the case with the percent of stocks above their 50-day moving average, because they're well below that peak. That is negative divergence. Okay, I think we'll wrap it up here. I don't want to beat a dead horse. They're all pretty much saying the same thing, and you're going to see similar divergences also on the S&P 500. You may not see it on the NYSE indicators. That's not, in my opinion, as accurate index to use. So I like to use the Nasdaq Composite and as well as the S&P 500, and there we are. So we're going to end it here. And again, divergences aren't sell signals. They're merely indications of a likely trend change. Same with overbought conditions, things like that. So we'll watch those levels covered in the first video for maybe some earlier sell signals, whether they come tomorrow or 3 months from now. And then how do things look there? How do the charts develop? And then we'll start to turn our focus out to the daily and even maybe the weekly charts. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.